Welcome, everyone, and thank you for taking some time out of your day to educate yourself on a topic important to your retirement and your overall financial well-being. My name is Tori Gutierrez, and I, along with my partner, Alex Sierra, will be speaking about all things IRA planning today. Mine and my team's mission is to empower educators, public service employees, and nonprofits with the education, financial strategies, and tools to thrive. Cetera Investors is a subsidiary of Cetera Financial Group, the home of the second largest firm for independent financial advisors. Our open architecture platform allows us the tools to plan for our clients holistically, whether that's putting together a plan to budget and save, protect your family and future goals with life insurance, manage your investments, retire, and much more. Today, we'll be answering some of the most common questions when it comes to individual retirement accounts, or IRAs for short. When it comes to your IRAs and other retirement accounts, your questions might sound something like, what type of IRA makes the most sense for me, if any? How are my withdrawals taxed? When do I need to begin taking withdrawals? How much will I have to take? And what happens to my IRA when I die? And also relevant to the current tax environment, how can I manage my tax liability both now and in the future to ensure that my money lasts throughout my retirement? So we'll get to all these questions throughout our presentation today. Before we get into the more complex concepts, let's review the basics of IRAs. A traditional IRA, or individual retirement account, is a personal retirement account that offers certain tax benefits. Contributions may be tax deductible, and while your money is inside the IRA, it grows tax deferred. Ultimately, when you take your money out of your IRA, the amount you take out is generally added to your income, and we'll talk a little bit more about that later. In 2020, the maximum that you can contribute to a traditional IRA is $6,000. If you're 50 or older by the end of the year, though, you can contribute $7,000 to an IRA for the year 2020. The contributions are also the same for 2021. So you can't always make a traditional IRA contribution, though. For instance, to make a traditional IRA contribution, you must have what the tax code refers to as compensation. For most people, compensation is income earned from working, but it also includes a number of other types of income, such as taxable alimony. It does not, however, include things like interest, dividends, capital gains, Social Security benefits, or unemployment compensation. So, most of the time, if neither you nor your spouse work, you won't be able to make a traditional IRA contribution. In the past, age was also a barrier that prevented some people from making traditional IRA contributions, as such contributions were prohibited once an individual reached the year that they turned 70 and a half years old. The Secure Act, however, the law that was passed at the end of 2019, eliminated that restriction. As a result, no matter what your age, if you have compensation, you can make a traditional IRA contribution. And traditional IRA contributions are deductible unless you or your spouse are active participants in an employer-sponsored retirement plan and your income exceeds an applicable threshold amount. Those limits depend on your filing status and who's contributing to an employer-sponsored plan. If you are covered by a retirement plan at work and your modified adjusted gross income, or AGI, is $65,000 or less and you file single, you can deduct your full traditional IRA contribution. If you are covered by a retirement plan at work and your modified adjusted gross income is $104,000 or less and you file married jointly, you can deduct your full traditional IRA contributions. So both of those things have to be true. Many of you probably know that there's another type of IRA called a Roth IRA. Roth IRAs are similar to traditional IRAs in many ways, but there are also some key differences. One of those differences is that you don't get a tax deduction when you make a Roth IRA contribution. So once your money is in a Roth IRA, it grows tax deferred like it does in a traditional IRA. A big benefit of a Roth IRA, though, and another key difference between it and a traditional IRA, is that a Roth IRA distribution can be tax-free in retirement. If you've had any Roth IRA for more than 5 years and you're over 59 and a half, then all withdrawals from your Roth IRAs will be tax and penalty free as part of what's known as a qualified distribution. Even if you need to take a withdrawal sooner, you can always take out your Roth IRA contributions tax and penalty free, just your contributions. Some of the same contribution rules that apply to traditional IRA contributions also apply to Roth IRA contributions. For instance, the same 6,000 contribution limit applies for those under 50. If you are over 50, you can contribute up to $7,000 into your Roth IRA. Roth IRA contributions are also subject to the same compensation rules as traditional IRA contributions. If you have sufficient compensation, the only thing that can prevent you from making a Roth IRA contribution is having too much income. You can see the income limits up here on the screen for 2019. Note that if you're a single filer, as long as your income is under 124,000, you can make a full Roth IRA contribution. Similarly, if you are married and file a joint return, then as long as your income is under 196,000, you too can make a full Roth IRA contribution. So the relevant numbers for 2020 are, if you are filing your taxes as a single person, your modified adjusted gross income must be under $139,000 for the tax year 2020 and under $140,000 for the tax year 2021. So just increased in 1 year just a little bit. If you're married and filing jointly, your modified adjusted gross income must be under $206,000 for the tax year 2020 and under $208,000 for the tax year 2021. While some baby boomer couples retire at the same time, oftentimes one spouse retires before the other. In such cases, you may be able to take advantage of spousal IRA and or Roth IRA contributions. These are special contributions that allow a spouse with compensation to make a contribution to a traditional or Roth IRA of a non-working spouse. In other words, the non-working spouse can use the working spouse's compensation as their own. The spouse for whom the contribution is being made, however, must meet all the other contribution rules applicable to the type of IRA. You might be asking yourself, can a $7,000 contribution really make a difference when it comes to my retirement? And the answer is absolutely. Here's a quick example. Suppose you're 55 years old now, and you plan to retire in 10 years at age 65. The kids have flown the coop, and you finally have a chance to focus on saving for your retirement. So you make a full $7,000 Roth IRA contribution annually until you retire. If, say, you earn 6% per year, then by the time you retire in 10 years, you'd have close to $100,000. But remember, you may need to plan on living until 90, 95, or longer. So let's say that you leave the account alone and it continues to earn 6% per year. By the time you reach age 85, even if you never put another dollar in after the first 10 years, you'd have nearly 300,000. Plus, since you made contributions to a Roth IRA, that entire amount would be tax-free. And just think, if you're married and you're able to make that $7,000 contribution to both your Roth IRA and your spouse's Roth IRA, you'd have twice as much tax-free. Of course, at some point, you're likely to retire. or potentially change employer, potentially switch jobs, or potentially get laid off. And when you do, you'll be faced with one of your first major retirement decisions: what to do with the money you've accumulated in your employer sponsored retirement plan, whether it's a 403b, 401k, SEP IRA, etc. In many cases, people choose to roll their funds over to a traditional IRA or a Roth IRA because they tend to offer greater control over one's retirement funds. These are not the only options, though, and such rollovers may not always be the best move. Believe it or not, you may have as many as 6 different options for your employer sponsored retirement plan funds once you leave work. You can see them here on the screen. So each of these potential alternatives offers unique benefits and drawbacks. So it's usually a really good idea to discuss your options with a knowledgeable professional so that you can make the savvy decision that's right for you and your family. All right, getting money into your retirement accounts is only the first half of the story. Coming up with an efficient way to take those funds out and avoiding costly mistakes is the other half. This is far easier said than done, especially when it comes to your traditional IRAs, 401ks, 403bs, and other pre-tax retirement accounts. In general, withdrawals from these accounts are taxed at ordinary income tax rates, just like interest. Your withdrawals are added to your income and taxed at whatever tax bracket you happen to find yourself in when you take it out. If your overall income is relatively low, you might have a low tax rate for your withdrawal. On the other hand, if your overall income is higher, your tax rate will be higher and more of your IRA withdrawal will end up in Uncle Sam's hands. Here's a quick look at the tax brackets for single and joint filers for 2020. For the tax brackets for single and joint filers for 2021, it's a little bit, the dollar values are a little bit higher, but it's generally around the same for your marginal tax rate. One of the troubling aspects of IRA planning is that the tax rate on your future distributions is unknown. Even if you can project your income with relative confidence, there is no real guarantee that tax rates will remain the same. And while it's hard to find someone who doesn't think that they pay too much in taxes now, the reality is that the top tax rates today are pretty low in a historical context. So take a look at this chart to see exactly what I mean. When the income tax was first introduced in 1913, the top tax rate was only 7%. But within just a few years, the top rate had already skyrocketed to over 70%. After dropping back down to as low as 25% after World War I, the top rate jumped to 63% in 1932. From there, it wasn't until more than 50 years had passed when, in 1987, the top tax rate finally dropped back below 50%. Now, of course, not everyone pays that top rate. In fact, it's only a very small percentage of taxpayers that do. That said, with our national debt at all-time highs, a budget that hasn't been balanced in years, and fiscal troubles for many of our entitlement programs like Social Security and Medicare, it is possible that rates can go up across the board, which makes coming up with the right plan even more important. To make matters a little bit more complicated as well, your IRA withdrawals can cost you in a lot more ways than just adding to your income. They can also cause you to be phased out of itemized deductions, personal exemptions, and various tax credits. They can also increase your exposure to the 3.8% surtax on investment income. If you take an IRA withdrawal, you might have to include more of your Social Security benefits in income, and your Medicare Part B premiums can increase as well. If you want to try to avoid these issues, then you really need a plan of action when it comes to distributions from your IRA. So that's where I leave off. I hope that was helpful so far. I'll hand you over to Alex to take you to the end.
Thanks, Tori. So like you mentioned, I'll be taking over for the rest of the presentation, which includes a brief review of required minimum distributions, as well as a few savvy IRA strategies for you to consider. So first, we'll start with required minimum distributions, which we call RMDs for short. So almost all traditional and pre-tax accounts will have some sort of RMDs. But since these accounts are pre-tax, meaning they've never ever paid taxes, we know that eventually Uncle Sam is going to come for his tax dollars, and they do that through the form of RMDs. RMDs begin for IRAs once you turn 72. Specifically, the first RMD is due by April of the year you turn, or the year after you turn 72. If this number looks a little bit odd or different to you, it's because it's recently changed. So previously, RMDs began at the age of 70 and a half, but the Secure Act that passed in 2019 pushed back the age to 72. One note is that this applies not only to IRAs, but also most employer-sponsored retirement accounts like 401ks and 403bs as well. RMDs are very important to keep in mind, especially since the penalty for forgetting or making an error can be really costly. Failure to take an RMD can result in a 50% tax penalty. So that's pretty steep, so we always want to do what we can to avoid that. For some with multiple accounts, required minimum distributions can get quite complicated. Here's a few common mistakes to consider and hopefully help you avoid. So mistake number one is aggregating RMDs between different types of investment accounts. So for example, if you have, say, a 401k through work and an IRA, you will have RMDs for both accounts. So say you have a $2,000 RMD for your 401k and a $2,000 RMD for your IRA. What some people think you can do that you cannot actually do is aggregate these and just take, say, a $4,000 RMD from only your 401k and assume that that satisfies the RMD for both accounts. However, this isn't the case. You're going to have to take an RMD for every type of account that you have. So if you have a 401k, you'll have an RMD for that account. If you have an IRA, you'll have an RMD for that account. Now, if you have two IRAs, since those are technically the same type of account, those would be okay to aggregate your distributions between. So you could take a total IRA RMD of 4,000 if you owed that but had two IRAs. But note, you can't do this for different types of accounts. Another common mistake is aggregating RMDs between spouses. So the same logic often applies. People think that with them and their spouse, say I have a $2,000 RMD and my spouse has a $2,000 RMD. Sometimes people think they can just aggregate that and maybe I just send over $4,000 RMD. However, this isn't the case. And this is because all retirement accounts are coded as individual accounts. So therefore, RMDs cannot be aggregated between spouses and each must pay their own RMD. The third common mistake is forgetting to take an RMD and doing nothing about it. So unfortunately, this happens way too often. And this especially happens with smaller accounts that maybe people forget about because they aren't planning to utilize it in their financial plan. But don't forget about these accounts because the penalties for not taking an RMD are large and can grow over time if you continually forget to take your required minimum distribution. All right, so now that we've reviewed the basics of IRAs, Roth IRAs, and RMDs, let's move on to a review of 3 savvy IRA strategies that you might consider implementing at some point. So savvy IRA strategy number 1 is to hold off taking IRA distributions. Note that this strategy is only advisable if your specific situation allows. It's very common for life events to occur that might force people to make IRA distributions earlier rather than later. However, if you have the ability, holding off on taking your IRA distributions may be advisable. So some of the possible benefits of this strategy include one, this strategy allows your IRA funds to grow tax deferred as long as possible. So, the longer your money stays invested in your IRA, the more time that those investments have to grow. A second benefit is that keeping your IRA or holding off on taking IRA distributions helps in keeping your IRA income off of your tax return for as long as possible. So when you do take an IRA distribution, remember that that's going to get added to your taxable income. So every year you're able to delay taking an IRA distribution is a year where you will not have to report anything additional in your taxable income. The third benefit of this strategy is to avoid the potential side effects of IRA distributions for as long as possible. So Tori already reviewed some of these potential side effects earlier, but the most common ones include the negative effects on Medicare premiums, Social Security taxation, and your eligibility for some really important tax credits. So if you don't take distributions from an IRA, then you don't have to worry about these potential side effects. There are some potential drawbacks and limitations to the strategy. So some of those include pretty much things to do with the future taxation on your IRA. So as your IRA grows, so does Uncle Sam's share as well. So likely at some point, and certainly after you turn age 72, you will be making distributions from your IRA. So if during that time period you hold off on taking IRA distributions, you actually risk paying more in taxes later down the road if tax rates increase by that point in time. So while this strategy can be effective for growth of your IRA and limiting your current tax liability, this strategy could have potential tax consequences later down the road. We definitely recommend discussing with your financial professional whether it makes sense to hold off on IRA distributions or make them at this point in time. Your advisor can help review the pros and cons as well as how they apply to your specific situation. The second savvy IRA strategy will be to look at Roth IRA conversions, or Roth conversions for short. A Roth conversion occurs when an IRA or similar pre-tax retirement account is moved over to a Roth IRA. The amount you convert is considered taxable and added to your income in the year that you do the conversion. So, for example, say Jill has an IRA with $100,000 that she wants to convert. She would start by moving the $100,000 over to a Roth IRA. That year, when she does her taxes, she would have to add that $100,000 to her taxable income and then would be taxed according to whatever tax bracket she's in. So before completing a Roth conversion, we would definitely, again, recommend talking to a tax professional. Recent revisions to the tax law have now prevented any do-overs or recharacterizations of Roth conversions. So it's pretty much a final decision once you decide to do the Roth conversion. So with this, they still definitely remain a great option, but now you just want to be extra sure before finalizing a Roth conversion. So you might ask, why do a Roth conversion, especially if it means that you're going to be owing more in taxes? One reason is the benefits that come with having a Roth IRA. The biggest benefit of having a Roth IRA is that all distributions are both tax and penalty free, as long as you meet the requirements of a 5-year holding period or at least 59 and a half. If you're over 59 and a half, then you don't have to worry about the 5-year holding period. These tax-free distributions can be extremely beneficial in retirement, and this is especially true if tax rates go up by the time that you retire, right? Because tax rates could end up being higher at that point in time than at the time when you did your conversion, which means you would have paid less in taxes in the long run. In addition to tax-free distributions, Roth IRAs are also free from having to take RMDs. So having no RMDs eliminates the hassle of having to withdraw from your account every year. It also prevents you from being forced to liquidate when you otherwise may not have needed to or wanted to. In addition, when we're looking down the road to the next generation, a Roth IRA can also be beneficial. Um, when a Roth IRA is passed down to a beneficiary, the beneficiary does not have any RMD requirements and is also not responsible for paying taxes since the account is already an after-tax account. In contrast, a traditional IRA, when that goes down to the next generation, the person who inherits the IRA is going to have RMDs and are also going to have to pay taxes on the money as they withdraw it on the account. So when we're thinking about the next generation, moving your money into a Roth IRA is typically a preferable option there. Like I mentioned earlier, especially now that there are no do-overs or recharacterizations when it comes to Roth conversions, it's important that you are 100% sure. So before doing the conversion, these are 3 potential questions to ask yourself and then also review with your financial professionals. Number 1, do you have a rough idea of the conversion's impact on your tax bill? This is really important because you don't want to create a tax liability that you can't afford. Number 2, do you have a plan to pay the resulting taxes? So you want to decide, where is that money going to come from in order to pay those additional taxes when you do the conversion? And then number 3, do you have a reasonable expectation that the benefits of prepaying your taxes like this make sense in your overall plan? So basically with this, you just want to make sure that your Roth conversion makes sense for your overall plan and doesn't negatively affect anything. So your financial advisor and tax professional can help review your specific scenario and help come up with answers to those questions. One of the other main questions that we get about Roth conversions is how much should I convert, right? So there's no one size fits all answer to this question, but one strategy to consider is a strategy called filling up the bracket. This is a Roth IRA conversion strategy that involves converting just enough to fill up your current marginal tax bracket. So remember the way that marginal tax brackets work. In this example here, somebody is in the 22% tax bracket. So that means that the first chunk of their income is taxed at 10%, the next chunk is taxed at 12%, and then the rest is taxed at 22%. In this strategy, I'd convert whatever amount takes me to the top of the 22% tax bracket. This locks in a tax rate of at most 22% for your converted IRA money. While this strategy may or may not make sense for your specific situation, it is usually more practical and also more feasible than converting your whole traditional IRA all at once. All right. So the third and final savvy IRA strategy that we're going to look at is coordinating your IRA planning. So while IRA planning is definitely one of the most important parts of retirement planning, it's only one piece of the retirement puzzle. IRA planning should be coordinated with other aspects of your plan, such as your overall retirement plan, your estate plan, any tax planning you're doing, and also any education planning you're doing. So making sure that you're working with a financial professional can help ensure that you're incorporating the holistic view of your financial plan when making these decisions. It's especially important to coordinate your IRA planning with your Social Security planning. So this is really important, but unfortunately, most retirees or many retirees do not properly evaluate the decision of when to apply for their Social Security benefits. So this is a tough decision, and deciding when to claim your benefits is certainly a personal decision and depends on a variety of factors. But typically, one can take Social Security as early as age 62 and as late as age 70. Generally, the longer you delay your Social Security benefit, the bigger your monthly benefit will become. However, even though this is the case, you'd be surprised many retirees end up claiming Social Security earlier than they should, even though they know that delaying can get them a bigger monthly benefit. Given this, for some, it often makes sense to maybe take money from your IRA for income instead of filing early for Social Security. The reason to consider withdrawing money from your IRA instead would be to delay your Social Security and therefore let the benefit get bigger and bigger. Reports have actually shown that Social Security is often the cheapest annuity you can buy. So think about this. If the price of Social Security as an annuity is considered all the other assets that you would have to utilize while delaying a Social Security, this price essentially buys you an annuity, right? And the annuity is what we would consider the additional monthly income that you receive from delaying Social Security. With that in mind, reports have actually shown that doing this actually gets you an annuity at a better deal than one can typically find on the private market. So this all kind of goes to show that if your plan allows, delaying your Social Security benefit can be very beneficial. A financial plan that has a bigger reliance on a Social Security benefit is actually generally more tax efficient than one that relies on frequent IRA withdrawals. And this is true because depending on your income level, at least 15% of your Social Security benefits are going to be 100% tax free. So if we're thinking about our income in retirement, the higher percentage that income is that comes from Social Security, the better off I'm going to be from a tax perspective. All right, so that pretty much concludes our reviews on IRAs, Roth IRAs, and some savvy strategies that go along with them. We wanted to leave you with one final reminder to really utilize your financial advisor as a resource, especially when it comes to questions related to IRA planning. So we can help you in a variety of ways, whether it's generally reviewing your financial plan or looking at the specifics. So maybe choosing between a traditional IRA and a Roth IRA, maybe helping you determine the feasibility of, Roth conversions. And maybe it's looking at your Social Security benefit and helping you determine whether to take your Social Security or to take money from an IRA. So lots of different ways that you should really leverage your advisor to help you along the path there. So with that, I just wanted to thank all of you for taking some time out of your day to enhance your financial knowledge on IRAs. We hope you found the information beneficial, and we look forward to posting new videos on relevant topics in the future for sure. So be sure, if you haven't already, to subscribe to our YouTube channel, and also reach out to us and let us know what other topics you want to see videos on. But yeah, until then, and until next time, on behalf of Tori, myself, and our Soterra Investors team, thank you. Have a good one, everyone.